Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me back.
Of course. Today we're doing a deep dive into something that, honestly, it might keep some of you up at night. Imagine waking up and finding out that the financial safety net you've been building, for decades, is actually mathematically engineered to fail in our current economy.
Yeah, it's a really sobering realization for anyone relying on traditional financial advice right now.
Right, because according to recent analysis, the undisputed champion of investing, like the classic 60-40 portfolio, isn't just, struggling a little bit. In the macroeconomic era we are entering right now, it might be fundamentally broken.
Broken is the right word.
Hmm.
And to grasp why this massive shift is happening, I mean, we really have to look closely at the landscape right now here in July in 2026.
Right, the macro backdrop is totally different now.
Exactly. I mean, under the current Trump administration, we're navigating an economy that is heavily focused on industrial policy. We're talking national manufacturing, rearmament, and drastically shifting global trade dynamics.
Yeah, the era of frictionless, cheap global trade, it just feels like it's completely behind
It
us.
really is. And the data from early July completely reflects that pivot.
Oh, absolutely. Just looking at the numbers, the U.S. unemployment rate dropped to 4.2% in June. But more tellingly, on July 6th, Federal Reserve Governor Christopher Waller issued this really stark warning.
The inflation warning.
Yeah. He pointed out that while the labor market might be stabilizing, the real looming risk right now is that high inflation could return.
Mm.
I mean, the market is already pricing in a potential interest rate hike this September.
Which, fundamentally alters how capital moves. It changes everything.
So how do we make sense of this? Where do we even start?
Well, this ties directly into a framework based on Neil Howe's concept. It's called the fourth turning.
Right, the generational cycle theory.
Yeah, exactly. It's this historical theory suggesting that society and economies, they move in these 80 to 100-year cycles.
Mm.
And based on this recent analysis, we're leaving a long era defined by stable prices, hyper-efficiency, and global free trade.
And entering something much bumpier.
Very bumpy. We're entering a new phase defined by deglobalization, persistent supply chain shocks, and recurring waves of inflation. So if that premise holds true, the traditional definition of a safe asset, it basically has to be completely rewritten.
Wow, okay, so let's examine the mechanics of why the old rules are breaking down. The 60-40 portfolio, so that's 60% stocks for growth, 40% bonds for safety, it relied on a very specific mathematical relationship, right?
Correct. It was a golden rule.
Yeah, and we've always thought of it like driving a car. Your stocks are the gas pedal, providing forward momentum and growth, and your bonds are the brakes, providing friction and safety when things, get out of control.
That's a great way to look at it.
Thanks. I mean, for 40 years, whenever the stock market hit an icy patch and crashed, bond prices naturally went up, which cushioned the blow. You were safe. And we all saw the brutal reality of this back in 2022, stocks and bonds fell in tandem.
They absolutely did.
The assumption that bonds are the ultimate ballast is already showing serious cracks. So what happens when we hit the brakes now?
Well, to push your car analogy further, in a high inflation environment, hitting the brakes while the engine is revving, it just sets the brake pads on fire.
Oh, man. That's a terrifying image, but it makes so much sense.
Right. Because when inflation spikes, central banks are basically forced to raise interest rates to cool the economy down.
Yeah,
And higher rates, they act like gravity on stock valuations.
because the cost of borrowing money becomes painfully expensive for companies.
Exactly. But simultaneously, those exact same higher rates crush the value of your existing bonds. Because think about it, new bonds are being issued with much higher payouts. So the inverse correlation, the whole reason the 60-40 rule worked, it just disappears.
So in an inflationary shock, bonds aren't a safe haven at all. They just become another risk asset. I mean, you're bleeding from both sides of your portfolio.
Exactly the issue. You're losing everywhere. And global markets, they aren't just dealing with a simple, isolated inflation problem right now either.
Right. It's like everything everywhere all at once.
Exactly. They are juggling multiple massive variables at the exact same time. We've got sticky inflation data, intense NATO defense spending talks, aggressive swings in global energy prices,
European industrial conflicts, yeah.
all of it. So the old assumption that holding a government bond will just magically insulate you during a crisis, it completely collapses when the crisis itself is inflation.
Okay, so if bonds are failing to act as our brakes, I mean, as investors, we can't just keep driving without a seatbelt. Where do we put the 40% of our money that's supposed to keep us safe?
That is the million-dollar question. And based on the sources we are unpacking today, the first major pivot in this new framework is moving away from traditional long-term bonds
Okay, and moving toward what?
toward real, tangible assets.
Hard assets. Got it.
Yeah, we're talking about raw commodities here.
Hmm.
Things like copper, energy, agricultural products, alongside precious metals like gold and silver.
Okay, so how does that work mechanically? Like, how does a chunk of copper replace a U.S. Treasury bond?
Well, mechanically, these assets act as targeted shock absorbers specifically against inflation and supply chain disruptions. Think about it. In a world where the cost of living and the cost of manufacturing are rising, the underlying raw materials required to build the modern world naturally appreciate in price, too.
Right, because everything costs more to make.
Exactly. They provide a direct hedge against the exact force that is destroying the value of your fiat currency.
But historically, I mean, commodities are incredibly volatile. We aren't just trading one risk for another here. We are actually changing the nature of what we consider growth as well, right?
Oh, absolutely. We have to.
Because this strategy doesn't just swap out the defensive side of the portfolio, it fundamentally changes the equity side, the stock side, too.
It does. I mean, if you look at the winning stocks of the past 40 years, they were built on a foundation of cheap, global labor, rock-bottom interest rates, and, honestly, consumer technology.
Right. Think about the massive software applications, social media platforms, the big e-commerce giant.
Exactly. Those consumer stocks thrived in a deflationary, highly globalized world. But the recent analysis suggests the next decade is fundamentally about making stuff, not just buying digital services online.
Right.
The focus of global capital is shifting rapidly to the production side of the economy. Things like defense, industrials, power grids, AI data centers, robotics.
You know, it makes me think of a massive nationwide home renovation.
Oh, how so?
Well, for the last 4 decades, we've essentially been spending all our money on fancy interior decorating, right?
Right? Software, consumer tech, the apps that make life comfortable.
Exactly, things that are aesthetically pleasing. But now, driven by shifting geopolitics, supply chain vulnerabilities, and, the Trump administration's heavy focus on national manufacturing, we are finally waking up to the fact that the house itself has structural issues.
That's a brilliant way to put it.
So now, capital is flowing out of interior decorating and into fixing the plumbing, reinforcing the roof, and upgrading the security system, which translates to heavy industrials, copper miners, defense contractors.
That is a highly accurate way to visualize this macro shift. We are literally rebuilding the physical foundation of the economy. And the market data from early July 2026 proves this isn't just a theoretical exercise.
The money is already moving.
It is aggressively moving into these sectors. European markets recently experienced a massive weekly surge, but it wasn't led by consumer tech or software. It was led by defense, industrials, and banking.
Wow.
Yeah, capital is rotating out of pure AI software hype and grounding itself in the real economy, the companies responsible for physically building and defending the infrastructure.
Okay, so let's summarize so far. We swap some bonds for hard commodities to protect against slow-burning inflation, and we rotate our stocks into heavy-duty production and infrastructure companies.
Right.
That addresses the inflationary, deglobalized environment. But, and here's my big beginner question, commodities don't solve an acute, terrifying market crash, do they?
They do not.
Right. I mean, if we get a true black swan event where the market drops 20% in a week, copper and oil are going down with it. So how is this new framework actually hedging against sudden market crashes? What's the new insurance policy?
This is where we have to introduce some more sophisticated mechanics to the portfolio. The third and fourth pillars of this upgraded framework focus on entirely different forms of insurance. We're talking about managed futures and options hedging.
Okay, let's start with managed futures. Keep it simple for us.
Sure. Mechanically, managed futures are essentially algorithmic trading strategies. They operate across global futures markets, so equities, fixed income, currencies, and commodities.
So they're just computer programs trading based on data, but what are they actually doing? Are they trying to predict the future?
Not at all. And that's the beauty of it. Rather than predicting economic fundamentals, they are purely reacting to price momentum. They're trend surfers.
Trend surfers. I like that.
Yeah, they don't care if a market is intrinsically overvalued or undervalued. They simply identify an existing trend and jump on it. If global currencies or major stock indexes begin to crash, a managed futures algorithm will automatically take short positions, profiting from the downward wave.
Oh, I see. So they surf whatever wave is currently forming. If the wave is crashing downward, they surf it down, making money off the crash.
Exactly.
Yeah.
And that generates positive returns that offset the bleeding in your long-term stock holdings. It's a non-correlated return stream.
Okay, it adds a dynamic, reactive layer of protection that static bonds just can't do. But, and this is a big buddy, but trend followers need a little time for a trend to establish itself, right?
They do, yes.
Yeah.
It's not instantaneous.
Right, so what about a sudden, violent overnight crash? A trend surfer isn't going to catch a wave that happens in 5 minutes.
You're completely right. And that requires the fourth pillar, tail risk hedging, which utilizes options contracts.
The fire insurance.
Exactly. This is where we get into momentum crashes. Based on July 6th data, momentum stocks, especially the massive AI technology companies, have surged roughly 40% globally over the last 12 months.
That kind of crowding is historic. Everyone is piled onto the same side of the boat.
Yes. And history issues a very clear warning about this. When every active and passive dollar crowds into the exact same trade, the eventual unwind is violent.
So how do options protect us from that?
An options hedge is a direct mathematical defense against that exact scenario. By purchasing put options, you're essentially buying a contract that pays out exponentially if the market takes a sudden, severe nosedive.
But let's be realistic about the cost here. I mean, isn't buying options basically paying for fire insurance on your house?
It is very much like that, yes.
Because you pay the premium every single month, it drags down your overall profits during a calm, rising market. And honestly, it feels like a total waste of money 99% of the time.
It absolutely eats into your returns.
But on the day the kitchen actually catches fire, that insurance policy is the only piece of paper in the world that keeps you from going bankrupt.
That is the perfect analogy. The drag of the portfolio is real, and investors have to accept that cost. Tail risk hedging will bleed your returns during a bull market because you are constantly paying those premiums.
Right.
However, in a 2008-style liquidity cascade or a sudden burst of the AI momentum bubble, it provides the vital oxygen your portfolio needs to survive. It generates massive immediate cash.
Which is huge because it prevents you from being forced to sell your high-quality assets at rock-bottom prices just to meet margin calls or fund your retirement.
Exactly. It mathematically forces you to buy low because the hedge pays out exactly when everything else is cheap.
I love that. But let's step back for a second, because not everyone has the access, or frankly, the desire, to manage complex options contracts and algorithmic trend surfers. It sounds exhausting.
It's definitely not for everyone.
Right. But there's one tool in this framework that everyone has access to. A simple tool that honestly gets a terrible reputation in an inflationary environment.
You're talking about cash.
Yes. Good old cash in the bank.
It's the fifth pillar. And you're right, the conventional wisdom is that holding cash during periods of high inflation is basically financial suicide. Beginners are constantly told that cash is a lazy asset, just losing its purchasing power to inflation every single day.
Right. Cash is trash, is what they always say. But according to the research we're examining today, when market valuations become dangerously stretched and crowded like the current AI stock bubble we just talked about, cash transforms from a lazy liability into a highly strategic weapon.
It does. It provides ultimate optionality.
Yeah.
When you hold cash, you aren't giving up on the game. You're preserving your ammunition.
It's like holding a VIP ticket to the best sale of the decade.
Exactly. When the market inevitably experiences a massive panic liquidation, the investor holding cash is the one standing there with the exact currency required to acquire phenomenal assets at massive discounts.
And we really can't ignore the psychological anchor it provides because the mathematics of buying low are obvious, but human nature makes it nearly impossible to actually execute.
Emotions take over.
Totally. I mean, if you are 100% invested and the market drops 30%, you are terrified. Panic sets in. You want to sell everything just to stop the pain. But if you are holding a strategic reserve of cash, a market crash suddenly stops looking like a tragedy and starts looking like a generational opportunity.
It stabilizes your emotions completely. It prevents you from making terrible, panic-driven decisions at the exact wrong moment. Cash provides options both literally and figuratively. It allows you to survive the volatility without emotional capitulation.
Okay, so we've completely reconstructed the classic portfolio. We've replaced the failing bond breaks with inflation shock absorbers like copper and energy. We've rotated stocks from consumer tech into heavy-duty production stocks. We've added algorithmic trend surfers, mathematical fire insurance, and a strategic stack of cash.
It's a completely different vehicle.
It is. And on paper, for an inflationary, deglobalizing decade, this sounds incredibly robust, bulletproof even. But we have to play devil's advocate here. Investing is never perfect. What happens if this grand macro narrative is just wrong? What are the actual risks of abandoning the traditional 60-40 rules entirely?
Well, that is a vital reality check. We have to look at the neutral counter-analysis found in the data, because investing based on grand historical narratives like the 100-year fourth turning cycle, it carries inherent risk. History certainly rhymes, but it rarely repeats on an exact, precise schedule.
Right, we don't have a crystal ball. The Trump administration's industrial policies might face friction, or supply chains might adapt faster than we expect.
Exactly. And the second really crucial counterargument is this. What if inflation actually cools down organically? What if the Federal Reserve successfully engineers a soft landing without triggering a massive crisis?
Which is entirely possible, because according to data released just days ago on July 3rd, U.S. employment numbers actually came in a bit soft.
Right.
And that data point alone weakened the U.S. dollar and boosted gold. If the global economy actually slows down and a traditional deflationary recession hits, inflation will just plummet.
And in a deflationary recession, those traditional, boring, long-term government bonds that we just stripped out of the portfolio, they will actually rip higher.
Oh, wow.
Yeah, they become exactly what you want to own. If you go all in on commodities and inflation protection, and we get a normal, say, 2001-style recession, this new portfolio model could severely underperform.
That is a massive risk. We can't ignore that.
Furthermore, execution really matters. These new defensive tools, the managed futures and options, they come with significantly higher management fees than just buying a basic bond index fund.
Oh, yeah. Wall Street always gets its cut.
Always. And if the market just chops sideways for 5 years, those fees will slowly, quietly bleed your returns. And finally, thirdly, consider the overcrowding in those production stocks we analyzed.
The defense contractors, the AI data centers, the industrials.
Right. They might already be so popular among institutional investors that they are priced to absolute perfection today. If a macroeconomic story is too obvious, the market has usually already priced it in.
That makes total sense. So the goal here, the takeaway for the listener, isn't to dump your entire 60-40 bond portfolio in a fit of panic tomorrow morning.
No, absolutely not.
It's more about realizing that the era of a magical set-it-and-forget-it strategy is definitively over. You have to actively understand what specific risks you're actually trying to hedge against.
Exactly.
Because if your primary fear is a prolonged inflationary decade, you need exposure to hard assets and commodities. But if you are guarding against a sudden deflationary bust or recession, you absolutely still need traditional fixed income.
You've nailed it. The core thesis of all this research we've looked at today is simply that the fundamental definition of a defensive asset has fragmented. It's changed.
It used to just be bonds.
Right. For 40 years, playing defense just meant buying a treasury bond. Today, defense is highly contextual. It might look like a barrel of oil or copper. It might be a defense contractor, a mathematical trend-following algorithm, or just plain old cash sitting in a bank account. Long-term investors must build a portfolio capable of surviving multiple different macroeconomic futures, rather than betting their entire retirement on the one future they think is most likely to happen.
It's about building a financial vehicle that is resilient regardless of the terrain it ends up driving on. You can't just rely on the brakes anymore. You need four-wheel drive, a reinforced chassis, and a navigation system that adapts to the weather.
Beautifully said. You are managing a spectrum of risks, not trying to perfectly predict tomorrow's news cycle.
Well, this has been a deeply illuminating look into the shifting mechanics of the market. We've gone from realizing our traditional financial brakes might be failing to fundamentally rebuilding the engine with production-focused assets and layering in entirely new safety systems designed for a world of sticky inflation and shifting global trade.
It's a lot to process, but it's crucial information.
It really is. So I want to leave you with a final provocative question to chew on today. If the long era of effortlessly riding low interest rates, blindly buying consumer tech stocks, and trusting bonds to save you is truly coming to a close, take a look at your own retirement account or your 401k today. Look closely at the actual mechanics of what you own. Is your financial future still anchored to the easy realities of 2010, or is it actually built to withstand the much rougher realities of 2030?
Great question to end on.
Don't forget to subscribe and hit that like button.